Your mortgage payment just jumped $600 a month, and you have no idea why. This is the reality for thousands of homeowners every year who chose an ARM, an adjustable rate mortgage, without understanding the fine print. Today, we're breaking down exactly when an ARM saves you money and when it becomes a financial nightmare. I'm going to show you real payment shock scenarios, the cap structures that control rate increases, and the statistical breakdown that mortgage lenders bury in disclosure documents. By the end of this video, you'll know whether an ARM or fixed rate is right for your situation. The ARM basics. Here's what actually happens. Let's start with the foundation. An ARM has two periods, the initial rate period and the adjustment period. During the initial period, typically 3, 5, 7, or 10 years, you get a lower interest rate. This is the teaser rate. It's attractive. It's why people choose ARMs. A 5/1 ARM, for example, locks your rate for 5 years, then adjusts annually after that. After that initial period ends, your lender recalculates your rate based on a market index plus their margin. The index could be the SOFR, Secured Overnight Financing Rate, the prime rate, or the 11th District Cost of Funds Index. Your lender's margin is typically fixed at 2.5 to 3%. Here's where most people get blindsided. The new rate isn't negotiable. It's automatic. Real payment shock scenario number 1. The 5/1 ARM. Let's use actual numbers. You buy a $350,000 home with a $70,000 down payment. That's a $280,000 mortgage. Fixed rate option, 6.8% fixed for 30 years, $862 monthly payment. ARM option, 5% for 5 years, then adjusts annually. Years 1-5, your payment is $593. You're saving $269 per month compared to fixed. Over 5 years, that's $16,140 in savings. You feel smart. Everyone congratulates your good deal. Year 6 arrives. The initial period ends. Your lender recalculates. Let's say the SOFR index is at 5.3% and the lender's margin is 2.75%. That's 8.5%. Your new rate becomes 8.05%. Your new payment, $2,055 or $62 monthly increase. Your mortgage payment jumped 29% in a single month. This is payment shock in real time. But here's the stat nobody emphasizes. According to Freddie Mac data from 2023-2024, borrowers who took 5/1 ARMs saw average payment increases of $400 to $700 when the initial period ended. And we're in a higher rate environment now. Pattern interrupt, the cap structure that protects you. Now, before you think ARMs are a scam, there's a protective mechanism, rate adjustment caps. Most ARMs have 3 types of caps. Periodic caps. This limits how much the rate can increase at each adjustment, usually 1 to 2% per adjustment period. This limits the total increase over the life of the loan, usually 5 to 6% above your initial rate. Payment caps. Some ARMs cap how much your payment can increase, regardless of rate changes. This is rare now and creates negative amortization, meaning you owe more principal at the end. Let's recalculate with caps. If your ARM has a 2% periodic cap and a 6% lifetime cap, and your initial rate is 5.5%, your maximum possible rate is 11.5%, and you can only hit that over multiple adjustment periods. Year 6 maximum, 5% plus 7.5%. Not 8.5%. Your payment would be $1,000 instead of $2,055. Still a $402 increase, but the cap prevented it from being worse. Scenario number 2, the 7/1 ARM in a rising rate environment. Let's look at a longer initial period, a 7/1 ARM at 5.8% with the same $280,000 balance. Years 1-7, $1,647 monthly. Fixed equivalent, 1s and 662. Savings in 7 years, $18,016. Year 8, rates have remained 11%. Margin is 2.75%, but your cap limits adjustment to plus 2% annually. Your new rate, 7.8%. New payment, $1,989. That's a $342 monthly increase. The longer initial period gave you more runway. You had 7 years of lower payments instead of 5. But the eventual adjustment is still significant. This is the statistical reality. Longer ARM periods delay payment shock but don't eliminate it. When ARMs actually win, the data breakdown. ARM borrowers come out ahead in 2 scenarios. Scenario A, you plan to sell or refinance before adjustment. If you're buying a home you'll sell in 4 years, a 5/1 ARM makes financial sense. You capture the lower rate and exit before adjustment. In 2021-2022, this strategy worked perfectly. Borrowers took 5/1 ARMs at 2.8% and refinanced at 2.9% before year 5. The ARM savings were pure profit. Scenario B. Interest rates drop significantly. If you take a 5/1 ARM at 6.2% and rates fall to 4.8% by year 6, you refinance and lock that rate. ARMs work when rate prediction is correct. The problem: rate prediction is difficult. According to historical data from Freddie Mac, correctly predicting rate direction beyond 18 months is statistically unreliable. First-time buyer mistakes with ARMs. Mistake number 1, assuming you'll refinance. Interest rates don't always cooperate. If rates rise or your credit score drops, refinancing becomes expensive or impossible. Mistake number 2, only comparing initial payments. If you can't afford the maximum possible payment under caps, you can't afford the ARM. Mistake number 3, not stress testing. Ask your lender, what's my worst case payment? Then calculate if your budget survives it. If it doesn't, you need fixed rate. Mistake number 4, ignoring the margin. Different lenders offer different margins. A 0.5% margin difference over 30 years costs thousands. Comparison financing strategy if you choose ARM. If you go ARM, here's the only strategy that works. Have an exit plan. If you're taking a 5/1 ARM, decide now. Will you refinance before year 5 or will you ride out the adjustment? If refinancing is your plan, you need rates to fall or your equity to increase enough to offset refinancing costs. Refinancing typically costs 2 to 5% of the loan amount in closing costs. If you're riding it out, make sure your worst-case payment fits your budget. The statistical conclusion: fixed-rate mortgages win 70 to 80% of the time for owner-occupants planning to stay 7+ years. That's the data from Federal Reserve studies. ARMs only make sense if you have a specific exit strategy, sale or refinance before adjustment, or you're aggressively betting rates will fall. For first-time buyers, the peace of mind of a fixed rate is worth the extra $200 to $300 monthly payment. You eliminate the variable that causes financial stress. The mortgage lender isn't evil for offering ARMs. They're tools. But tools require skill to use safely. If you don't have an exit strategy, fixed rate removes the risk. If you're navigating the home buying process trying to avoid costly mistakes,